Let's talk now with an economist who happens to be one of Bloomberg Best. Just to remind you, Bloomberg Best means we bring you only the best people on the economy. We've crunched numbers to find the most accurate forecasters in the world. And filling that bill, this man, Michael Feroli, the chief U.S. economist for JPMorgan Chase. Michael, great to have you on the show. Like to begin with GDP. Drop back some to 5.6%, a little weaker than the survey. But would you agree that still shows economic recovery's got some real traction here?
Oh, yeah. It's still a very strong number. You're down a few tenths from where we were before, but not much of a surprise there, and still obviously I think a real strong number, and it looks like we'll probably have a pretty decent number again in the first quarter, maybe 2.5% to 3%.
That's still a decent gap down, though. So when do you think that we'll get a real consistent plus 5% level of GDP expansion, including, and here's the difficult part of the question, job growth?
Well, it may be I think it may be tough to get consistent 5% growth. I would expect a little bit of an acceleration from the first quarter, which may have been depressed a little bit by weather. But we would expect job growth to start picking up in the next few months. I think the March job number, of course, you're probably going to get some job growth that's going to be temporary from the census. But I think, underlying private job formation probably begins to take place in the spring.
And I guess just part and parcel of that, even though we're looking ahead to a possible drop in that jobless rate, Michael, right now we still have weak compensation.
That's right, very weak compensation. So in that fourth quarter number we just talked about, you had corporate profits up 8%, and so you saw that income was basically all going to really to capital and to profits, and very little of that was going to compensation and labor income. We would expect that again to pick up as the job market improves, but so far it's really been the benefit of the recovery is really mostly accrued to profits.
Moving on to the consumer here, Michael, you've got good consumer spending numbers, but weaker consumer sentiment. Is that a disconnect?
It has been. It's been a disconnect for a couple months now. The retail sales data has been really strong. It looks like auto sales will be up in March, and yet consumers and the consumer sentiment numbers are still at very low levels. So it is a bit of a disconnect, and it probably does reflect some of the concerns about the job market. Even as consumers are coming out of their foxhole a little bit and spending a little more, there's still definitely a lot of concern out there.
Well, since that number, as you mentioned, is stuck at a low level, does that at least kind of cloud the metric a little bit? How do you read that?
It has clouded the metric, and I think using consumer sentiment surveys to think about and forecast consumer spending has kind of broken down over the past few months, and so it does leave us in a little bit of limbo here.
So do you have to change the paradigm then?
Well, not necessarily. Look, the level of consumer spending is still below the peak of where it was before the recession began. So it may partly reflect that even though consumer spending is growing, it's growing off a very low level. And so consumers may be increasing their spending, but still not happy overall.
And our Al Hunt just interviewed former Federal Reserve Chairman, of course, Alan Greenspan, who said one of the main risks to the economy, as I'm sure you're well aware, are these federal debt issues, sovereign debt issues, especially in Eurozone right now. So how big of a risk do you see that and possible contagion for the U.S. economy?
It's definitely something we worry about. I don't think the move we've seen in rates over the past week is enough to really think that that's going to put the brakes on the recovery. But I think this was a wake-up call and a reminder that deficits do have consequences, and can serve to crowd out private capital formation. So that is it's definitely a risk. I don't think what we've seen so far means that we're off track, but it's something to keep on the radar screen to worry about.
Did you have any thoughts on the outcome of the bond auction this week? A couple of them that really demanded exceptionally high yields, and we saw a lot of volatility in the bond market this week. Curious for your impressions there.
Right, as I said, it is a bit worrying how abrupt that move was. I don't think we're generally feeling that rates are very far from fair value, and I do think that they're probably going to move higher over the course of the year. But as I said, I don't think they've thus far moved so high that we're thinking that the recovery is getting derailed.
But does the U.S. need to be a little bit more concerned about its federal deficit?
Yeah, definitely. I would not want to be on the other side of that argument. I think what the message we got this week is that there are consequences from these deficits, and so it should really enter back into the policy debate.
Michael, we have about 30 seconds left. As far as the Fed's concerned and as far as any movement on rates, is this one of those things where, at least for now, the Fed will stay put because that unemployment level is so high?
Yeah, I don't see the Fed moving rates anytime this year, not only because of high unemployment, but also because of very weak inflation.
Those inflation numbers, the expectation numbers, though, they are pretty soft, right?
The expectations are subdued, and the actual inflation numbers are very soft. So I think the combination is going to keep the Fed on hold for quite a while.
Michael Feroli of JPMorgan. He is the chief economist and one of Bloomberg Best. Many thanks. Have a great weekend.